Is the Fed losing control over the repo market? SOFR has now spent 5 consecutive days above the Fed's upper bound, and we aren't even at the end of Q4 yet. As pressure builds into year end, are we facing a repeat of the repo rate crisis? So even the bulls are admitting that the Fed is losing control over the most important price of all, the price of money, the price of a dollar, the interest rate on an overnight dollar loan, otherwise known or referred to as SOFR, the secured overnight financing rate, which just spent its 5th consecutive day above the Fed's upper limit. Now, remember, the Fed is trying to control that most important price, the interest rate on an overnight dollar loan, with these tools. The discount window and the standing repo serve as their tools to try to control the ceiling on the interest rate for an overnight dollar loan, right now at 4%. That's the Fed saying, no matter how scarce dollars get, we will always sell them to you at 4%. And the hope is that you keep SOFR below that limit. However, for 5 consecutive days, SOFR has spent its time above that upper limit. But as we will see, it's actually even worse than that once you dig into it a little bit deeper. Now, the reverse repo is the exact opposite. That's the Fed saying, no matter how overabundant dollars get in the plumbing of the financial system, we will always buy them at 3.75. And that's the Fed trying to control the floor in the price of money and make sure that SOFR does not dip below that reverse repo interest rate. However, these tools are not working. And even Conks, who is a pretty noted defender of the Fed and discounter of any claims of dysfunction or stress. Even Conks, in this article that I would highly recommend everyone read, admits that the boundaries are not working. The Fed tools that they try to use to control the overnight price of money, SOFR, are not working. And I wanted to point to, and Conks references in the article, called it the leaky lower bound. But I want to go back to 2022 and show that this is true. We've been focusing, of course, recently on SOFR being above the upper limit. But this is true, as Conks points out, to the downside as well. So in 2022, when the system was awash with money and so much liquidity had been flooded into the plumbing of the financial system, and we were just overflowing with dollars, SOFR was actually dipping below the Fed's lower bound. So, for example, here, Tuesday, the 14th of June in 2022, we can see that SOFR was at 70 basis points. Well, the reverse repo was up here at 80 basis points. So SOFR was actually below the Fed's lower bound, meaning that they were losing control over the price of money because there were so many dollars awash in the system that they were not able to accurately contain SOFR into their range because there was such a flood of liquidity. Well, just as in 2022, SOFR was going below the Fed's lower limit because there was way too much liquidity back then. Well, now, of course, we know SOFR is going above the upper limit. Now, what I want to point to is December. So we are in December, obviously December 3rd, but going into year end, liquidity stress generally builds. So here, by the way, we can see last year going into the end of 2024, of course, not only quarter end, the end of December, but also year end. And we can see that SOFR started to become elevated above the reverse repo, which is the spread that we're looking at in the lower pane. SOFR went from being about 8 basis points all the way up to about 13 basis points above that reverse repo award rate. And the problem with this is that we are already spending time, a significant amount of time, 5 consecutive days above the Fed's upper bound. If we are going into the end of quarter, end of year, end of December sort of liquidity stress, what is going to happen if SOFR starts to increase to the degree that it generally does at the end of the year, where liquidity becomes quite tight? If we get another 20, 30 basis points of increase in SOFR above and beyond the reverse repo or Fed funds or whatever you choose to use, if we get a widening of the spread, it'll be from an already pretty elevated level. Of course, we have spent 5 consecutive days above the Fed's upper bound. But wait, it gets even worse. So we talk about SOFR and we show it in the chart, the yellow line, that SOFR interest rate as the median. But remember that the $3.3 trillion repo market, there's a wide range, wide distribution of interest rates that get financed in this $3.3 trillion overnight lending market. If you look at the 75th percentile, of course, we talk about the median SOFR, and that is what is most widely reported. But if you look at the distribution, look at the 75th percentile, and then realize that 25% of that 3.3 trillion is getting financed at this interest rate or above. And if once we look at the 75th percentile, we can see that the liquidity stress isn't just 5 days. We can see that the past month and a half, 25% of SOFR lending has occurred above the upper limit for the past month and a half. And not just by 1 or 2 basis points. We're talking 10, 15, 20, 25 basis points above that upper limit. So the liquidity stress is not evenly distributed. Yes, if you look at median SOFR, 5 consecutive days above the upper bound is notable on its own. But once you look into the distribution, dig a little bit deeper and realize that 25% or about $800 billion is getting financed above the upper bound, the story starts to look much different. Now, why is this occurring? Well, remember, we are going into the end of quantitative tightening. So December 1st, actually 2 days ago, we already entered the end of quantitative tightening. The Fed was decreasing their balance sheet. Well, as they were letting assets roll off and mature off of their balance sheet, that had a destructive effect on bank reserves. Now, someone pointed out the other day that bank lending, private bank credit creation was up, growing at 4 or 5%. And I wanted to make a distinction that M0 or bank reserves, which is really what we're talking about, currency grows at a relatively constant rate. Bank reserves are the other half of the monetary base, that M0. That is dependent on the Fed. That is much different from M2, which is that broad way to measure the money supply. That includes, of course, much more private bank credit creation. It's akin to going to Chuck E. Cheese. I'm a millennial. Go to Chuck E. Cheese as a kid and you get your tokens. Well, within the Chuck E. Cheese, you can transact with those tokens. Those tokens are as good as money. However, for the company, for the business, for the building, when they have to go to pay rent, they're paying in dollars. Think of that as the monetary base or M0 and the tokens as M2. So that is probably the best way to think about it, or at least the best way I could come up with to try to draw that analogy between M0 and M2 because they are different. Yes, private bank credit creation M2 is up at an all-time high. And when we look at the Fed credit report, we can see that credit is continuing generally to grow at a healthy rate. However, bank reserves are dependent on the Fed. The Fed creates bank reserves out of thin air, and then they inject those to the banks by buying financial assets from the banks. Well, quantitative tightening just ended 2 days ago, and we are probably going to transition into a QE type of environment where bank reserves are once again created by the Fed and injected into the banking system by buying securities from the banks like mortgage-backed securities or U.S. Treasuries. That is the cure. Yes, you could also run down the TGA to inject right now about $900 billion. However, remember, that TGA balance needs to stay up around $900 billion because we have $650 billion of Treasury bill redemptions every 5 days. And so the Treasury needs a buffer in case the government gets shut down for a couple days. They need to have $650 billion just to make it through 5 days of Treasury bill redemptions. Now, zooming in a bit, we can see that liquidity did marginally improve. It was at this spread, reverse repo minus standing repo, was at negative 22 billion yesterday when we did yesterday's video. It is improving. However, it is still negative. This spread is still negative. And I once again want to point to the very strong negative correlation between bank reserves and the SOFR spread that we look at, specifically SOFR minus RRP, the 10-day average, because of course there is a lot of day-to-day volatility with SOFR. So it helps to look at the moving average. What is the moving average telling us? It is telling us that liquidity stress has been building for months now. We started doing videos on this back in August. This has been apparent to anyone that looked. The stress has already been building, and we're going into year end. If the Fed just continues to say, okay, we're done with quantitative tightening, we're not going to start quantitative easing type program where we're easing liquidity conditions, well, all those end of year, end of quarter pressures are going to build. And as we see time after time, SOFR spreads widen into the end of year as liquidity becomes more tight. Well, that would be happening into an already tight liquidity environment where, again, SOFR spent 5 consecutive days. The median SOFR has spent 5 consecutive days above the Fed's upper bound. So we're going to have to watch and see. The Fed very well might come out and announce some sort of reserve management program where they announce that they are going to create bank reserves, once again, print money, and inject that into the banking system by buying assets. So, anyways, hopefully that was helpful, and I'll catch you in the next.